Hey friends, the stock market is absolutely crashing. I have a lot to share today. I want to talk about my strategy and what I'm doing as a dividend stock investor during this tariff-induced market crash. I want to first share some good news. It's good to be a dividend investor. Procter Gamble, for example, on Wednesday this week, as you can see on the screen, they increased their dividend by a strong 5%. This was on a day when the market was in absolute free fall. Even though the market was in free fall, Procter & Gamble had the confidence to increase their dividend by 5%. That's why I like to focus on dividends versus equity share prices. As you can see on the screen in front of you, it's really exciting. I started buying Procter & Gamble stock back in 2011. Since then, the stock has gone up a lot, but that's not why I invest. I invest because of dividends. And my first tranche, simple yield on cost, is now almost 7%. But the dividend news just keeps getting better. Philip Morris, today, they paid a massive dividend. Again, the market was tanking today, of course, but that did not stop Philip Morris from paying out their huge, massive dividend. And in fact, I started buying Philip Morris in 2009 at $38.29. So if I take the annualized dividends now of $5.40 and divide by my purchase price, my first tranche, simple yield on cost, is now a staggering 14.10%. And that doesn't even include reinvestment. Stocks go up, they go down, but dividends in a very well-diversified, high-quality portfolio, they tend to grow steadily over time. Of course, though, they are not immune from setbacks. What are we seeing right now in the stock market? We're actually seeing a cycle repeat that I've lived through a few times right now. The biggest times that I've lived through this in recent history were the great financial collapse, the great financial recession crisis of 2008, 2009, the pandemic, and now this tariff news as well. But what's happening? Let's talk about this cycle. As you can see on the screen in front of you right now, there are cycles in the stock market that repeat themselves. And when you become a more seasoned investor, it becomes very clear. Step one is really the horrible news. And the horrible news this time has to deal with tariffs. These tariffs, I'm not trying to make a political statement. I have a lot of thoughts about these tariffs. I don't know if I want to share them because I don't want to really upset any viewers. I'm going to keep my political beliefs off of the channel and just share my dividend beliefs. This is dividend investing for everyone. I think we can all agree, though, that the tariffs from the market standpoint, the stock market that is, and the bond market now, it's horrible news. The tariffs have really upset the markets. And they came up unexpectedly. But as you can see on the screen in front of you, what happened? Well, the horrible news that came out this time, last time it was the pandemic, before that it was the great financial crisis, it was that Lehman Brothers moment, but the market tanked. And stocks tanked, but also now we're seeing bonds tank because bonds are tanking, the Treasury yields are going up. I suspect some other countries perhaps are selling bonds. We don't know, but that's pretty likely. That's probably why they're collapsing. But anyway, the market tanks. We're seeing red, red, red. I'm buying. I'm now all the way on the right-hand side of this chart. When I buy, I focus on quality. The market tanks. What's great about that is oftentimes it's a broad-based sell-off. Some people are asking me, Ian, we're seeing all the stocks tank now, even the defensive dividend stocks, the high-quality stocks. Why are they all tanking? Well, what happens in a crisis like this, in a panic, is traders out there are probably getting margin calls and they need to sell everything to raise liquidity. I think also investors get spooked. They liquidate everything, even the good quality assets like Procter & Gamble, for example. Everything goes down, and that can present a great buying opportunity for long-term investors like myself. But as you can see on the screen in front of you right now, what comes next? And so next in the cycle is really continued pain. Obviously, I buy the quality, but there's more pain. It just keeps going down. It seems oftentimes when you're caught up in this cycle, because it's a little bit different every time. I've not been through a tariff-induced market sell-off before, but it just seems to have no end in sight. None of us know when this is going to end. Now, yesterday, there was a large update. I leave this in red because we're still in a bear market. I think a lot of people yesterday, I saw this on different social media platforms, they were celebrating, hey, everyone, it's over. I'm up 10% in a single day. Keep in mind during these types of cycles, there's going to be a lot of bear market rallies like this. It's fake. Yesterday's update, this wasn't the signal of a bull market. Again, no, we are in a cycle of pain right now, and it will probably continue for a while. That's okay. As a long-term dividend investor, I like these downward cycles because I can buy high-quality stocks at lower prices. The lower I can get them, the more cash flow I get. It accelerates my retirement, my financial goals. But no, the pain's not over just because we saw a large update, and that's why stocks were down again today. We're still in a bad cycle here. But as you can see on the screen in front of you, let's keep going. And so we're now kind of at the bottom of the screen. This is what we saw today. The market, it tanks more. Investors now, they're probably starting to lose a little hope. They felt some hope yesterday. Now they don't have the hope. I just keep on buying. I'm trying to stay positive. I can focus only on what I can control right now. And what I can control is buying high quality assets at progressively better prices. I dollar cost average. I try to budget. I don't want to over deploy or deploy too much too soon. And so I just keep on buying. And eventually, this could go on for a while. It could go on for a few months, but things will start improving. It will get green again. And what's funny is when things start improving, it's not like a headline. It's not even like it was yesterday where things just surged up. It's kind of secret and silent. It can be slow and steady up and to the right. Things will eventually improve. They will. But there won't be some big shocking kind of big headline day behind it. It will just start happening when everyone has lost their faith. But the seasoned dividend investor like myself, I know the cycle, so I know what to expect. I just keep dollar cost averaging. But as you can see on the screen, let's keep going. So what happens next is really we will enter a bull market again eventually. It might take some time, but a lot of time has passed and the market will rocket to new heights again. And then we will be ready to start the whole cycle again. Of course, at some point in the future, there will be some horrible news and it will be different. It won't be a tariff. It won't be a tariff-induced panic. It will be something else. There is always drama. This is the cycle of the stock market and kind of human existence, in my opinion. I've learned to live with it. I don't like it. I don't like living through it, but I embrace it because I know what it is. And I invest in a style, in a manner that sets me up for success, knowing that this is the world in which we live. If I was just investing to buy low, sell high, that kind of strategy works for a lot of investors. It doesn't work for me. For me, I get a little too fearful during these cycles. I get a little too upset or frustrated at what's happening. And so for me, a more defensive strategy like dividend investing, it is suited to my level of risk tolerance. But let's talk about it this time versus last time. What's going on here? So as you can see on the screen in front of you right now, I just want to share really briefly. I'm sure all of you have been all consumed with the news, but what's happening last time, it's always something. And honestly, if it wasn't the tariffs, this is one big point. I think it would have been something else. We're probably overdue for one of these cycles. It's been a while since the pandemic. If it wasn't the tariffs, probably be something else. But last time what happened is we had the pandemic. There was a supply chain stoppage and it was shocked. Big time. The world shut down. We were all stuck in our homes. And to fix the situation, a lot of free money was injected into the system. And I say free with quotes because it led to massive inflation, which we all live with to this day. This time it's a little bit different. We're seeing, because of the tariffs, an international relations breakdown. A lot of longstanding partners that the United States has had with different countries are probably scratching their heads right now and thinking, hey, what's next? Some of these long-standing partnerships, relations, they're breaking down because our president is saying, I'm not trying to make a commentary right or wrong, but what he's saying, he believes, is that there are trade imbalances and tariffs that others are levying against the U.S. that must be quote unquote fixed or remedied in some way. It led to the US's tariff policy, which caused a breakdown in international relations and a breakdown in the stock market and now the bond market. But what else is happening? As you can see on the screen in front of you right now, there are a few things. The supply chain, it is starting to shock again. I'm already seeing reports that, hey, large companies are putting off buy orders on supplies that are coming from overseas, especially supplies that might be coming from China. Now what we're also seeing, in addition to stocks tanking, is we're seeing bonds tank. And because bonds are tanking, I'm talking about Treasury bonds, the rates are going up. The prices go down, the rates go up. It's making debt service for the US extremely expensive. The 10-year just recently was below 4%. Now the 10-year, I'm going to get to this later, but it's up to 4.4% actually as of today. And so the 10-year is a way up. It's going to be harder for the US to refinance debt. There's perceived inflation ahead because as we import goods to sell to consumers or to use as part of another good we're manufacturing and selling to an end consumer, the price is going to get paid. It's going to be paid by someone. It's either going to be the company or the consumer, and probably a mixture of both. We could see company corporate margins go down, but if we want to keep margins the same, consumers are going to have to pay those tariffs. And so we're going to see some kind of inflation, I believe. Now, obviously, a lot of the tariffs were rolled back, but that 10% across the board baseline is still in place, and the huge tariff on China is still in place. And so we have perceived inflation ahead. What else is happening this time? As you can see on the screen in front of you, there are a few more things. And so there's a perceived loss of profitability ahead. Again, as I just said, margins could get squeezed at certain companies. There's a perceived loss of international goodwill as well. This is something I worry about with stocks I own, like Starbucks and McDonald's. Could consumers internationally boycott those types of companies because they're upset with the United States and the strong stance that our president is taking at this time? And so again, not making a political commentary, but just trying to share objectively what I'm seeing out there in terms of the crisis last time and how it's a little bit different this time. It's something different. But I want to keep going. I have a few more thoughts. So what am I doing? What am I doing out there in the market? Well, I'm buying. And so as you can see on the screen in front of you, I'm doing a few things. I am buying SCHD. I keep averaging down on red days. I made a rule for myself. Hey, if it's a green day, I'm not buying anymore. It got to be a red day. And so I'm buying SCHD because it offers a high starting yield to pay the bills, dividend growth, and diversification. Diversification is really important in this kind of market because certain individual companies could really get hurt by this tariff crisis. Now, with SCHD, what I like about it right now is we're down about 16% from the 52-week high. Honestly, it's not too bad considering everything. A lot of the tech stocks are now down probably about 30% or so. The 4.16% starting yield is awesome. It's a qualified dividend, and I believe there's dividend growth ahead, although probably a little bit slower than that 11.44% we've seen over the recent last 5 years. But I want to share, I had a few trades. My patrons already know this. I'll link in the pinned comment below to my Patreon. I share my trades on paid patron tiers. But as you can see, here's just some of the trades. These are some of my recent trades on SCHD. And you can see I'm averaging in. I'm buying at all different prices. My best purchase was on the 7th of April, which was at 24.85. Second best, 25.01, which was today. And third best was on the 4th of April, which was 25.99. All of these have a starting yield based on the last 4 dividend payouts of 4% or more. And you can see my best purchase on 4/7, it was down 16.39% from the 52-week high. And so I'm happy with that. But what else am I looking at? I'm actually getting excited about this crisis a little bit. I'm being more positive here, honestly, than I am in my real life. My family members, I go home to the dinner table and I'm oftentimes complaining day to day these days about what's happening because I actually believe this crisis probably could have been averted. And I think there are probably better strategies out there, economically speaking. But again, I'll leave my commentary for the day at that. Put below in the comments, what do you think? Are you like the tariffs? You don't like the tariffs? Do you think it's a good strategy, a bad strategy? Put in the comments. I would love to hear. But obviously, I'm trying to be positive here for the community and for myself. But seriously, though, today I felt a little more positive because I started thinking about the Treasury yields and how treasuries, I actually hold some treasuries. I hold them through maturity. And so I don't take on a lot of risk with those. Yes, the US, could they theoretically default on debt? Yes, it's unlikely that it would happen. So I look at them as relatively safe as held through maturity, but I'm excited to see the yields spike. And so I think, hey, if this is something that China did, I don't know, but if they're selling our treasuries and the liquidation of those treasuries is forcing the yields up, thank you to China for that. For me, at least right now, it's not good for our government to have to refinance that huge amount of debt they have to refinance, but I'm assuming this is going to be short-lived. We never know. But anyway, as you can see, so check it out on the screen. Treasury notes, bonds, I like them. The yield pays the bills, diversification. I don't like big down days. I don't like seeing the overall portfolio tank too much, even though I do just invest for dividends. It's just my risk tolerance. And so anyway, I like the treasuries. The 10 years at 4.425, the 20 year at 4.906, 30 year at 4.87. The two that I'm looking at right now the most seriously are the 10 and 20 year. I like those yields. They're taxable as ordinary income, generally speaking, on a federal level, but no state and local taxes. This is not tax advice. Please consult your licensed tax advisor, backed by the U.S. government. But at those kind of yields, with the kind of volatility that we're seeing in the market right now, I expect going forward. What am I going to do? Well, I'm going to keep buying SCHD. It's my number one goal this year. And I got a bit of a gift trying to now kind of buy it on discount. But I got another gift. One of the things I wanted to do this year was diversify a bit more into different investments, including bonds, to buffer my portfolio from a downside perspective. Well, hey, bonds held through maturity purchased at these kind of yields, that does something for me. It does something for me, and I like it, and I'm going to probably be buying more Treasury bonds here going forward. But that'll probably be a little bit later from now, maybe in the future this year. I'm focused really on SCHD right now. And I'll link in the pinned comment below to my last SCHD video. But let's just summarize what is really happening in my strategy right now. As you can see on the screen, I have a quick summary slide. What's going on is, hey, I'm realizing that this period, it will eventually pass. I shared the cycle of investing before. Honestly, I highlight this in yellow at the bottom, but I'm going to share this first. I'm on Blossom. Check it out. Cool sweatshirt. Thank you so much, Blossom team, and my friend Brandon Beavis, co-founder of Blossom. I got a bunch of merch. I'm so proud of this. I don't know if you can see this, but it also says over here, ambassador, because I'm a Blossom ambassador over there. In terms of full disclosure, I'm going to include my link, my affiliate link in the pinned comment below. If you sign up for Blossom, it's free to get started, free to use the platform. There are paid tiers as well, but I'm compensated if you sign up. So in terms of full disclosure, I'm a Blossom affiliate, but also I have some exciting news in terms of full disclosure. I'm now a Blossom investor as well. So when you see my profile on Blossom, but I'm so excited because that has been providing so much moral support for me and other investors during these crazy times. And so if you want to connect with like-minded investors around the world right now during these crazy times for a little bit of support, a little extra support, you can find the support here on PPC Ian. Please don't forget to subscribe, but also on Blossom. And I'll be grateful if you use my link because I am compensated. And thank you, Brandon, for the sweatshirt. And thank you for the opportunity to be an ambassador over there on Blossom. But what else is in my strategy? As you can see on the screen right now in front of you, boy, I'm trying to, this is hard because I'm not doing this yet, but that's why I put try. Going forward here, I'm trying to avoid watching the news too much because it's just distracting me and wasting my time. No matter how much I watch news about tariffs, it's not going to change anything on the back end about tariffs. And so I'm going to try to live my best life while averaging into high quality stocks, ETFs, and bonds that are on sale. I'm not going to deploy too much. Cash reserves are critical. If this tariff war and these issues go on too long, maybe this time will be different than in the past, and it could hit all of us in a bad way, possibly. Hopefully not. I don't think it will, because every time in the past we've had a crisis, we've emerged from it, and I don't think this time will be different, but it could. So I don't want to deploy too much because cash reserves are critical. I want to enjoy life. Again, I should put try here, but I want to enjoy life because after all, the entire reason I invest in dividends is to enjoy life with more free time and spend time outdoors. Everyone, thank you for watching. If you enjoyed the video today, please go ahead and click the like button. And in terms of a full disclosure, I am long the stocks and assets mentioned today, the ETFs too. I'm long SCHD ETF. I'm long Procter Gamble, ticker PG. I'm long Philip Morris, ticker PM. I'm long Starbucks, SBUX, McDonald's, ticker MCD. Also, I'm long Treasuries. I own all of those in my personal stock portfolio, dividend stock portfolio. In terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed investment advisor first. I'm just sharing my journey for fun and entertainment. It's possible to lose money in the stock market. Stock market is high risk. It's highly volatile. So please consult your advisor first. Thank you for watching. Everyone, I can't wait to see you in the comments below. Let me know what you think. I hope I didn't offend anyone today. I tried not to include too many political thoughts in this video, just staying neutral. I'm team dividend stock investing, dividend stock investor. That's what I'm all about. Thank you for watching. I'll see you in the next video.